Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
I'm Danielle Nezel with BMO Exchange Traded Funds, and this is the ETF Market Insights webinar. Thank you so much for joining us, whether it's live on this Friday afternoon or to all our YouTube subscribers. If you're on the channel tuning in, thanks for taking the time. Today, we are going to talk about investing in international equities. But before we get started, here's our disclaimer slide. So, reminder to everyone watching today, we're not giving any advice today. We're not providing any recommendations. Today's session and all our sessions are about providing updates on the market, information, education, really just giving investors at home the tools and information they need to navigate markets and manage their own portfolios. Our friends from MSCI are here as well today, and the same applies to them. They're not providing recommendations or advice today, just merely education. So our panel of speakers today, a big welcome back to Paul Riccadella from MSCI. Paul is going to talk to us about international equities from the perspective of an index provider. And Steve Shepard back as well. Steve is a director and portfolio manager on our multi-asset team at BMO Global Asset Management. So a very warm welcome to our experts today. Well, our 1-minute ETF update today, hot off the press. Our report came in from National Bank with those flows going into ETFs. In February, investors looking at Canada, Canadian equities, and broad market Canadian equity ETFs. In the sector world, financial, tech, and material sector ETFs, we're seeing redemptions, but we're seeing flows, and a lot of flows going to energy, and no surprise there, as that is a top performing sector within, for plugged into the headlines, energy certainly doing well in the last couple months. But today we're here to talk about international equities, maybe something that Canadian investors might not have on their radar or might need more information about. I know we see the S&P 500 as one of the most popular exposures for Canadians, a lot of home bias in Canadian investors' portfolios as well with those Canadian broad market ETFs. But when we're thinking about building a total global portfolio, international equities actually make up a large part of the global broad market. So we're going to get into all of this right now. So Steve, for investors out there that might not be exposed to international equities, they might not know much about this asset class, can you introduce our audience to international markets? And then what makes international equities unique from a macro perspective?
Sure. Thanks, Danielle. International equities, I mean, the biggest challenge that a lot of investors here in Canada face is their natural home country bias. That's true of investors around the world. You tend to invest more in what you know. However, as a Canadian investor, you would be severely limiting your opportunity set. With only 3% of the global market cap coming from Canada, there's a lot of very good companies around the world that you would be missing out on if you limited your portfolio only to domestic equities. So of course, our next closest neighbor would be the US, and we can talk about the US market in a moment. But the reality is that international companies are the homes of some of the best companies in the world across every sector. The other thing about the Canadian economy is that we tend to be very concentrated in a few key sectors. It is very important to go outside of our borders in order to access all of the industry sectors that make up the equity market. And one of the best ways to do so is through international equities represented by the MSCI EAFE index.
Thanks, Steve, and a great point that Canadian equity is really only 3% of the global markets. So Canadian investors really limiting themselves in terms of a global opportunity set. They're not looking outside of Canada. Now, let's dig a little deeper here. So if we look at the broad international equity market, what does it look like, and how is that so different from something like the broad US market that a lot of Canadian investors look for exposure to?
Sure. Well, if you take a look at the chart, the EAFE on the left, you'll see that financials does represent a large chunk, similar to Canada, a little bit lower than our, I believe it's somewhere around 25% these days. But what you'll see is that there is a much broader or more even distribution across all of the sectors. Whereas in the case of the US on the right, you'll see that information technology represents just over 28% of the index. Now, when you look further in some of those other sectors, for example, communication, you're going to find a lot of names that are what we refer to as technology plus. So under communication, that's where you're going to find Netflix, which trades to very similar multiples as information technology. Consumer discretionary, you're going to find Amazon, which, you know, some would say it's an online retailer, but really it's a technology driven company commanding some very high price multiples. So there's a very distinct growth bias within the S&P 500 index. And if that is your sole method of diversifying industry risk, you're going to find yourself taking on a lot of factor risk or style risk, tilting your portfolio excessively to technology and perhaps the growth style if you're more factor oriented. The EAFE index is just simply a better shopping mall, if you will, for some of the best companies in the world, with exposure to industries where we don't have as much exposure. For example, healthcare. Healthcare is a very small sector here in Canada. I think it's only around 2%. I'm sure our expert on the index can correct me on that, but it's also the nature of those healthcare companies, whether it's pharmaceutical companies or healthcare equipment. There's just a lot more diversification built into the EAFE index. And of course, being made up of several different countries, you're also removing a lot of the political risk associated with diversifying into a single economy, like you would be just here in Canada and the US.
Thanks, Steve. Now, we're using that acronym, EAFE, the MSCI EAFE. So this is an index that is one of the most popular proxies for international equities. Paul, you're here from MSCI. You're going to tell us all about what is the EAFE index or the EAFE index, and you know, tell us how popular it is.
Yeah, well, thank you so much for having me again, Danielle. And when I think about the EAFE index, it really goes hand in hand with the founding of MSCI and frankly, the innovative nature of our company. I know it might sound a little crazy to say in the context of a 2022 world where the global environment is quite interconnected, but our company was founded a little bit more than 50 years ago in the late 1960s, and the concept of creating an ex-North America index and finding the closing prices and calculating the index was quite a radical idea in the context of late 1960s investing. And so we were the first one to that marketplace. This was really the first innovation of many in MSCI's history. And because it's got more than a 50-year live track record, and because we were the first one to this space, it has become an overwhelming standard. And so you can see the numbers on this slide in terms of the active money managed against it. Pretty much every active mutual fund that is developed markets oriented, excluding North America, has MSCI EAFE as its benchmark. And then you see the indexed money that directly tracks this index. And I would argue that the 362 billion is actually a little bit of an underrepresentation, because EAFE is a subcomponent of some broader indexes like ACWI and World. And so if you add up the EAFE component of those two, you can easily get to scenarios where north of $500 billion directly tracks this index. So it's got a fantastic ecosystem and history associated with it.
Thanks, Paul. So the MSCI EAFE really is that standard benchmark or that standard index that investors all over the world are looking to, whether they're benchmarking against it as an active manager or just tracking it like an index ETF, certainly one of the leaders in the international equity benchmark space. So let's take a look at what that index looks like. So I know Steve gave us a little bit of insight on the sector composure, but Paul, could you elaborate a little more on that and talk to us about also those country weights and that country breakdown as well?
Absolutely. So just to add a bit to Steve's comment, so the MSCI EAFE index includes 21 developed markets countries that are ex-North America. So think Japan, as you can see, is the largest holding. The United Kingdom, European Union countries, et cetera, make up the vast majority of the index. Now, I think what is different than a lot of the domestic indexes that the audience may be familiar with is that this is constructed in a modern, seamless, and integrated way. Modern meaning that it continually evolves to measure and capture equity markets as they exist today. Seamless in terms of it covers the full opportunity set of all of the sectors and segments in those 21 countries. And then consistent in terms of we treat all 21 countries the same as it relates to the stocks that are eligible for inclusion in this index. And so at the end of the day, as you can see here, you have an index that has 822 constituents, covers 85% of the free float adjusted market cap of each country. And as Steve alluded to, the balance in terms of sector weights is much better than traditional North American exposure indexes. And what that translates to is a higher dividend yield for investors that care about that. It's almost double traditional North American indexes, and lower volatility overall because that sector balance and of course the roughly dozen different currencies have counteracting effects on one another. And so it really provides some nice diversity.
Thanks, Paul. So just going to go over what you said. So Canadian equities, you're thinking more cyclical sectors, more exposure to things like energy and financials. US equities, a lot more tech heavy, even outside of the IT sector, as Steve explained, some of those companies sitting in like Amazon or consumer discretionary stocks. Tech obviously had an amazing run, but we're seeing now growth stocks kind of sell off and cool off so far this year. And then that EAFE or that international equities, a lot more sector diversification, like Paul said, a little more defensive, and with that defensive nature, a little higher dividend yield as well. So thanks for showing us those differences there, Paul. Now, if we're actually looking at some of the top names in the portfolio or some of the biggest stocks by market cap in the international equity space, Steve, what kind of companies are in this portfolio, and then how are they different from like a broad US market?
Yeah, I think the real difference to take away from this slide here is just looking at how much concentration is in the top 10 of the EAFE index versus the S&P 500. I mean, with Apple being the largest, close to 7%, if you're going to be allocating via ETFs to broad markets like the S&P 500, you better really like Apple, you better really like Microsoft, and they're two excellent companies, don't get me wrong. But the key point here is that in terms of their influence on the overall performance of the index, it's certainly much more than even the largest. Nestle, I'm a big fan of their products. Anybody that likes chocolate certainly is. But when you look at the top 10, you can also see the different sector exposures. There's a lot more healthcare names showing up in the EAFE index than there are in the US. And again, back to that earlier chart on sector allocation, you can see that Apple, Microsoft, Alphabet are the two versions of Google, for those that are unfamiliar. All that technology exposure basically 2 out of the top 10, if I'm not mistaken, really are going to move in the same direction in any particular market. So if you compare an index to a shopping center, if there's only one shopping center in your town, you want it to have all 10 stores, all 10 market sectors of the index. And the EAFE index just has that, and it doesn't favor any one company to a large degree over the rest of the index. I mean, when you look at the S&P 500, you can imagine how small some of those positions are in the bottom half of the index. So when you look at an ETF, you really have to ask, is it moving as a homogeneous entity, like an economy, like a broad market, or is it really more heavily influenced by a couple of sectors or names?
Yeah, just looking at this slide, Steve, like doing some quick math, you have Apple, Microsoft, Amazon, and the 2 alphabets, which are Google. It's about 20% or almost 20% of those 500 names. So very, very top heavy. A big contrast over when you look over at the EAFE index, a lot less single stock concentration there. So thanks for walking us through that. Now let's talk about some portfolio stats. So Paul, you sent me this great data here. If we're looking at valuations, how does the EAFE index or international equities, how does this compare to other regions or other markets out there?
Yeah, so let me start with the very important caveat that this valuation data is something that we produce once a month at the end of every month. And clearly, since February 28th, there have been a lot of significant events in the world, and certainly significant market action as well. But I suspect a lot of the overarching principles still apply despite any market movement in the last week and a half in light of the Russia-Ukraine situation. And to answer your question directly, what we're doing here is comparing the price to forward earnings ratio. So the price of all of the stocks in the index at the index level, and then comparing them to the consensus estimate of forward earnings of that index. And as you can see, all of the 5 major MSCI indexes that we've analyzed here do have a current price to forward earnings that is greater than the historic average of those indexes. And there are very good reasons for that, right? 2021 was a fantastic year for equity markets. We are living in an era where interest rates are still quite low, economic growth has been robust. All of those factors are at play. But what you will notice on this slide is that the EAFE index has about an 11% premium relative to its historic average. The emerging markets index is slightly lower at a 10% premium, but the US and North America more broadly is at a stunning 40% premium versus its historic average. And when you look at world, which contains US as a component, as does all country world, otherwise known as ACWI, you will notice that their average premiums are also quite high as well. And so simply put, MSCI EAFE just offers better value right now versus its historic average for investors than do other indexes that are more North America or US centric. And I think a lot of that stems from some of the points that you made a few minutes ago, Danielle, with respect to the run up in the tech sector and other idiosyncratic things that happened last year that have really pushed valuations at home up to levels that are quite high.
Great, thanks, Paul. So yeah, just looking at this data across the board, valuations across the globe are a little higher or a lot higher, depending what region, than their average. But of course, the international equity is much, much closer to that average number than other regions. So let's drill down a little bit. So we talked about international equities as a whole. Now let's kind of look at the different components of that, because investors can use ETFs to get exposure to that MSCI EAFE index and get all the international equities, or they can play around and pinpoint specific regions within that to get exposure to. So one of those regions is just isolating Europe and looking at European equities. So Steve, maybe you can just introduce the audience. What do European equities bring to the table, and like what are you seeing for this asset class right now?
Sure, and I think the idea of how to split up international equities is an important point. Obviously, valuations are one decision point when putting a portfolio together, but I can just speak to our process. On top of valuation, we also consider things like the economic environment, policy, and that can be government policy or central bank policy. And finally, behavioral, which is more technical trading things and sentiment and stuff like that. But it's really the policy that I want to key in on. If you look to the US or Canada or anywhere around the world, central bank policy has really been one of the largest drivers of market behavior over the past several months, the more recent Ukraine conflict notwithstanding. So when you look at EAFE, you really want to ask yourself, what are the major central banks that are going to drive the markets in which these companies invest? So that would be obviously the European Central Bank, the Bank of England, and the Bank of Japan. Now here we've got the UK and Europe together. Their policy isn't moving in lockstep, but when you think about the region and the inter-border trade that happens across Western Europe, it makes sense to group them together. So here with a quality approach, you're not only getting the same broad sector diversification. In fact, Europe has more exposure to healthcare, less exposure to things like energy or financials, and depending upon where you go in Europe. But it's a nice offset to the structure of the Japanese index. So we actually like to consider Europe versus Japan as two separate entities, because very often in a broad market cycle, you get the opportunity for dislocations and rotations between the two of them. Very similar to what you can see between Canada and the US, just having different sector allocations. Quality is another important factor, and I'll leave that for Paul to speak to. But with Europe, really what you're getting is, again, market leadership, companies with large scale and moats around their business, something Warren Buffett always talks about, that really make them world-class companies. And if you look at, the average, when you go on your shopping trip, look at the number of products that go into your grocery basket that come from a European company. And I think you'll find that at least 50% of them, if not more, are probably coming from Europe.
Thanks, Steve. And now I'm gonna pass it over to Paul to keep the discussion going, or talk a little more about that quality approach when looking at European equities. So this is something that BMO ETFs partnered with MSCI on. We were thinking about bringing a European equity ETF to market, and putting that quality screen on those European equities made a lot of sense to us when we brought ZEQ out to market. So Paul, can you tell us a little bit about this screen and what the high quality Europe index looks like?
So a few important things I think to note on that, Danielle. First, in terms of the opportunity set, European equities represent about 50% of the number of stocks in EAFE, and a little bit more than 60% of the market cap. So it's a subsegment of EAFE. Obviously, it doesn't include Japan or Australia or any of the Asian markets, but still quite significant in terms of almost 2/3 of it being market cap. So now as it relates to quality, the MSCI approach to quality is a multi-definition approach. And as you can see on the middle of this slide, the three versions of that definition are high return on equity, stable earnings growth as measured by 5-year earnings growth, and then low leverage as measured by the debt to equity ratio. And we weight all three of these screens equally in looking for quality stocks to build our index. And effectively, what we do is we screen all 430 stocks within MSCI Europe on these metrics. We eliminate roughly 70% of the stocks that do not have good quality characteristics as measured by these three ratios, and then we reweight the remaining 30% of the stocks which do, taking into account both how well they score on quality as well as what their initial market cap is previous to the quality screens. And when you do all that and you construct an index, you get something that has about 30% of the holdings of the parent index, has fantastic quality characteristics. And what that translates to, at least in today's market environment, is a roughly 8% overweight to healthcare, a 7% overweight to consumer staples, a 5% overweight to industrials. And then from a country perspective, it's actually quite favorable to Switzerland, which has about a 7% overweight in the quality index versus the parent, a 6% overweight to the UK, and roughly the same for Denmark.
Thanks, Paul. And if you just look at the performance here, looking back to 2007, that quality screen has certainly made a lot of sense. Those market-leading companies outperforming that broad MSCI Europe index. Now, we know past performance not indicative of future results, but certainly in a time like this, when you're seeing a lot of geopolitical stress in Europe, especially, not just global markets, but especially in Europe, and the heightened volatility, rising rate environment, these types of companies with that low financial leverage, that stable earnings growth, it makes a lot of sense to think about these market leaders in a market environment like this. So,
and the last thing I'd add there, Danielle, that's a really good point. The beauty of quality is its durability. It is very good both in up markets and in down markets, more so than a lot of the other factors that investors tend to like, where they're more one-dimensional, either in up or down markets. Quality's track record in markets of varying types is pretty compelling over the years.
Yeah, Paul, we've said before, quality is for the bulls and the bears. For people who think markets are going up or people who think markets are going down, there's those characteristics that work in both markets for these types of companies. So I actually found this article about a year and a half ago, and it's an acronym that I really like. So I know most of the audience must be familiar with the FANG stocks, of course, coming out of the US equity market. But Goldman Sachs wrote an interesting investment research report. They're coming out with this acronym, the granola stocks. Now, this is kind of a quality European equity look at some of the largest companies in Europe. And so you have GlaxoSmithKline, Roche, ASML, Nestle. The stocks are all there listed on this slide. But when I was looking at ZEQ, BMO's high quality European ETF, a lot of these companies are in that, and it just makes sense. These granola stocks that Goldman Sachs are looking at are the blue chip, more stable, great earnings growth. They have all those characteristics. And here you see a growth chart of their market cap growing, certainly because of their strength in the market. So I just wanted to highlight that. If you'd like to read more about that report, just Google the granola stocks, Goldman Sachs, and you can read more about it. So now let's look at another region within the international equity space. This looks a lot different than European equities. Steve, can you introduce us to Japanese equities and talk about those differences from maybe a policy perspective or an inflation perspective within Japan?
Sure. I think, well, first thing is I talked about the four factors we look at, and looking at valuation, it was on screen earlier, relative to its historic levels of valuation. Japan is very attractive. We tend to look at a 5-year average, and when you look at the valuation versus a 5-year mean across markets, Japan does offer some very attractive opportunity at this point. What is different with Japan is the economic conditions. people that have followed that market are probably aware that it is a very elderly market, demographically speaking, in terms of number of productive workers to retirees. So their population growth is very limited compared to the rest of the developed world, and that has led to a very low level of GDP growth and virtually zero inflation. They're an economy that's actually struggled to generate inflation, which again is a timely conversation given other developed markets right now. But what we've seen more recently is that the 10-year yield in Japan has ticked up above zero, and that's echoing the upward movement of the US 10-year rate here. But when you look at the earnings yield that's offered in terms of Japanese equities versus the US 10-year bond, the safe asset, if you will, it's even more dramatic than you get from equities anywhere else in the world. And what you can see in terms of relative performance, you can see that Japan, since about 2013, has really started outperforming index. That's on the right chart. You can see that relative performance in the dark blue line. So at first glance, looking at the valuation of Japanese equities, it's attractive, but we do know, running portfolios, that valuation in the short term may not necessarily be a ticket to short-term outperformance. There's been a number of things that have stood out in Japan from a policy standpoint. In particular, their policies dealing with COVID during the pandemic for the past 2 years. They were fairly draconian in terms of locking things down, and that definitely had a limiting influence on their economic activity, as well as tourism, which is a large part of their economy. So those are two things that are loosening up, which we're optimistic about. But overall, Japanese equities offer a very good mix of cyclical businesses and also exposure to a lot of technology names that don't carry the same excessive valuations that you get from those FANG stocks that you see in the US index.
Okay, so let's take a look, Steve, at that portfolio. What can you tell us about the broad Japanese market in terms of the top holdings in a broad market Japanese ETF like ZJPN?
Well, in terms of performance, Danielle, it's timely. We were just having a conversation this afternoon about what markets do well in rising rate environments when the US Federal Reserve starts raising rates. And historically speaking, Japan has been near the top of the pack because it is a cyclical economy geared to global growth. And typically the Fed starts raising rates when growth is very strong, because growth is typically what generates inflation. Now, we've got more inflation than growth at the moment. That's another conversation for another day. But when you look at the makeup of the sectors, you can see that they are a manufacturing economy with industrials and consumer discretionary and technology. Anybody that tried to get their hands on a PlayStation 5, for example, yeah, I think Sony is PlayStation 5. You know, they saw what pricing power they can command based on the demand for those games. Industrials, everything from Toyota Motor Company, one of the world's largest car manufacturers. You compare that to, you know, the multiples that are being commanded in the industrial sector by Tesla. I read one article a while ago. If you take the market cap of Tesla and divide it by the number of cars they sell, you get a figure of around $1 million. With Toyota, that figure is around 23,000. So from a sheer valuation standpoint, there's a lot more attractive valuation opportunity in Toyota. But again, looking down at some of the names, it's very manufacturing focused. Japan tends to focus very heavily on industrial automation as well. So if you think about robots, you think about automation, how companies get more efficient in terms of increasing their margin through CapEx expenditure. That's really where Japan really stands out. And from a Canadian standpoint, it's actually a very good diversifier because you'll see that only 0.62% of the index is in energy. One thing about the Japanese economy is that they're almost completely dependent upon external energy. That's not such a good thing right now with oil prices going up as much as they are. But from a portfolio standpoint, it's good to invest in a market that's light on the areas that you're heavy on in your own home domestic equity portfolio.
Thanks, Steve, for introducing us to Japanese equities. Learning so much. That's teaching me things that I didn't even know. That's great. Now, before we close out, we're going to give an update on the Russian equities and their treatment in some of the indexes. Now, as a reminder, Russian equities are an emerging market traditionally. But Paul, being that you're from MSCI, and MSCI is, I think it's the leading emerging market index in the world. Can you provide us your update on how MSCI is going to be looking at Russian equities going forward?
Happy to, Danielle. So let me just give you the 2-minute version of the story. So obviously everyone is acquainted with the current events and the horrific situation. Effectively what we've done, so the last time the Russian equity markets were open was 2 weeks ago, Friday, February 25th, and very serious challenges in terms of international investors being able to buy and sell in that market. And after the market closed that day, we launched a very rapid consultation with the world's largest institutional investors to figure out if Russia was truly an accessible market. The key part of MSCI's index methodology is that everything is built from the perspective of the non-domestic investor. And if you are an international investor trying to transact in Russia, is it possible? And clearly, it has not been possible for the better part of 2 weeks now. And so we had a very rapid consultation with the world's largest investors in the first half of last week. By the second half of last week, we had announced that Russian equities would be pulled from the MSCI Emerging Markets Index. Just to give the audience some context, that means 25 stocks that made up roughly 3% of the index as of January 31st. That 3% number had dwindled quite a bit by the time markets seized up on February 25th. And furthermore, our announcement indicated that we would be exiting those 25 stocks at a price that is virtually zero, because the reality is any investors that are left holding Russian stock really can't get out of it, and it's effectively worthless to them at this moment in time. And so that went into effect earlier this week at the close of business on Wednesday. And so effective from that point, Russia is no longer a part of the MSCI Emerging Market Index. And the implication for any index tracking products linked to our index is that any tracking error that they are experiencing will be positive from this point forward, because the index assumes a value of effectively zero, whereas in reality, you would think that those stocks will be worth pennies on the dollar, maybe more, 2, 3, 4 weeks time from now. So in a nutshell, that is the process that we undertook from February 25th to March 9th to take 25 Russian equities, all of them out of the MSCI Emerging Markets Index.
Thanks for that update, Paul. And just as to maybe clarify for investors out there, if you are holding an emerging market index ETF like a ZEM, what that means for you is those securities are marked at zero, and our portfolio managers are monitoring the situation. We'll dispose of them when and if markets open up. But right now, they're in the portfolio, but they're marked as zero. But as you said, Paul, some of those companies, there's still valuations there. I mean, I can think of a company like Gazprom, certainly not a $0 company, just with markets frozen. That's what it's priced at right now. So thanks so much for that update. I'd love to remind our viewers, if you check out etfmarketinsights.com, you can find our BMO ETFs roadmap. There are over 1,100 ETFs listed in Canada. That is a lot to sort through. So what we've done at BMO, we've tried to make it as easy and as organized as possible for investors to see all the ETFs that we offer, at least in a concise document. So today we were talking about international equities. If you open up our roadmap, there's a section there for international, and you can see our offerings, everything from the BMO MSCI EAFE ETF that Paul introduced us to. We have an ESG EAFE ETF as well, also an MSCI index, international dividends, low volatility international equities, that high quality Europe ZEQ, and then of course our Japanese equity ETF there at the bottom. So everything's listed there for investors who would like to learn more. And if you click the ticker symbol, it'll take you right to the website with more information on that ETF. So a great resource to check out. We have time for a couple questions. Thanks everyone for sending them in. Please continue to send questions. It really helps drive our content. So today, question coming in from a audience member. In a rising rate environment, what should I do? Is it a hedged ETF or an unhedged ETF? And Steve, how do you look at the currency hedging process from your perspective?
It's an interesting question, and the definitive answer I can give is it all depends. It depends where you're coming from. So I'm going to assume this is from a Canadian dollar standpoint. The academic answer would be whichever bank is going to be raising rates faster, you want to own that currency, because bond market investors will buy that currency to invest in the higher yielding bonds. However, it's usually a little bit more complicated than that. It depends on expectations of how fast those rates are going to go up and how far, and whether that market is moving independently from everywhere else. So for example, the Bank of Canada has already increased rates 50 basis points, and we're waiting to hear from Jerome Powell, I think later this week or next, and whether he's going to go 25 or 50. Curiously enough, we looked at a study of the last 8 rate cycles and found that on average, the US dollar trade weighted index, DXY, actually fell on average by 3%. So if a currency is falling, that would suggest you should probably hedge back to the Canadian dollar. The real question is, though, what is the probability of that? In our portfolios, typically we hedge all of our fixed income back to Canadian dollar because we don't want currency fluctuation to overwhelm our decisions based on rate exposure and credit exposure. And on the equity side, we leave our ETFs unhedged because currency diversification can be very important, particularly during times of market volatility. And with the VIX index trading north of 30 on a regular basis over the past couple of weeks, I would suggest having some exposure to the US dollar and the Japanese yen, the 2 primary reserve currencies in the global marketplace, is probably still a good idea. So those are some things you might want to think about before deciding whether to hedge foreign currencies back to Canadian dollar.
Thanks for giving us those considerations, Steve. And again, maybe just high level, if you're unhedged, it gives you that little bit more diversification because you're exposed to the currency return in addition to the security return. You're looking at a hedged ETF, you're only exposed to the security return. You're hedging away the return of the currency. Last question here. We have someone looking for BMO ETFs that invest in Canadian pipelines and energy, looking for exposure to Alberta oil. I'm going to direct you right back to our BMO ETFs roadmap. We have a whole section on sector ETFs. So yes, we have the BMO Equal Weight Oil and Gas ETF, ZEO. If you want to learn more about it, check out our roadmap, click ZEO, and it'll bring you to our webpage with all the information and data that you need to research that ETF if you're interested in it. But of course, we do have a broad sector portfolio here. So there's other sectors you're looking at. They're all laid out on the roadmap. That's it for us today. I want to remind you to check out our YouTube channel, click subscribe. It really helps us grow our content, create better information for you, and build out our audience. Hope you enjoyed today's session. Thanks to Paul and Steve for joining us. And we hope to see you next week, whether it's live at 1 o'clock on Friday or whether it's later on demand on YouTube. Either way, we'll be talking about income investing. See you then.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, Thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.